Good afternoon, everyone. Actually, good morning at this point still. Hope you had a good weekend. What we are going to do, or what I'm going to do, first I want to go over just some details of what you can expect for the rest of the semester. Okay? Now, so as of today, I just wanted to let you know that we will be having our...
I don't know if it's on me, but I can't hear you.
Oh, you know what? You might have to log out and then log back in. Typically, that's what's happening.
No, I can't hear you.
Can everybody else hear me?
I'm trying to read your lips, but...
No, I think that's a lot. Everybody else can hear me, so you have to log off the system and then log back in, Lysander. That's typically what helps. Okay? All right. So, So just so that you're aware, we are going to be having our first quiz, and our first quiz is going to be on October 1st. Okay? So October 1st is going to be our first quiz, and it is going to be on this chapter that we're covering now. So it's going to be on chapter 10. Okay? Now, I'm hoping to do this quiz in a problem format, so you actually work out the problem. Okay, and you show how you got your calculations. All right, and it's similarly going to be like the drop downs for the homework. Unfortunately, that's what we're limited to. So what I'm going to be doing is the quiz on March 1st is going to be, I'm going to make it a little fancy. The quiz is going to be on McGraw-Hill, and I'll be putting this on the announcements. Okay, so the quiz is going to be on chapter 10 only. Okay, is going to be on McGraw-Hill for that half hour at the beginning of the class. But we'll be talking about it. I'll be reminding you through till then. Then, though, the midterm, okay, our first midterm is going to be on October 13th. Okay, so our midterm is on October 13th. And October 13th is a Tuesday. Yes. Okay, so the midterm, our midterm is going to include, the first chapter was chapter 12 that we covered, and it is going to cover chapter 10, and it is going to cover the next chapter, which is a lighter chapter. Okay, it's going to go through chapter 7, which is through the marketable securities. Okay, and I'll be reminding you, I'll be posting it on Blackboard. Oh, and our midterm, though, is going to be on Blackboard. Okay, so keep that difference in mind. Quiz, McGraw-Hill, midterm, Blackboard. Okay. All right. So, and the midterm is going to be like in the past, just 40 multiple choice questions. Okay, and also the quiz that the score you get on the quiz, up to 10 points. That is going to be what the score. That amount is going to then be added to your first midterm grade. Okay, so we're progressing through the semester. I hope everybody is well and keeping up with the studies. Okay, that's the important thing. I looked at our Apple Invest, our Phantom stock earlier, and I saw that our share of Apple stock was trading at $115.36. So again, it's fallen a little bit in price, but it is increasing. Okay, the market, Apple is actually driving the tech market a little bit right now, because for those of you who have the, just reading what's going on in the financial world, Apple is actually on its Apple Watch is going to basically have new features, and those features are going to be, you know, in these times when health is so important. What it's basically doing is it's going to have an ability that you're going to actually be able to track your longitudinal health. So you could track certain aspects of your health on your Apple Watch. Okay, that's what they've been developing, and also they want to be able to, so the individuals, in light of the pandemic, people are going to be able to look at videos such as exercise videos and things of that nature on their Apple Watches. So interesting. Okay, again, all going towards this whole pandemic mentality. What I love about Apple is that they're always so current. They're always so aggressive with what's actually a need in this world right now, with the health issues in Apple, as well as the tracking and the videos, which is going to be cool. Okay, so we're moving with our Apple investment. Again, it was about $119 last Thursday. It did fall to about 112 earlier yesterday, and now it's increasing a price again per share of common stock by 100. It's now $115.36. And again, this is the price that it's trading at after the stock split. Remember, we talked about stock splits in Chapter 12. This is post stock split. Okay, and so the dates, yes, Joshua, are 10/1 for the quiz on McGraw-Hill and 10/13 for the midterm exam. Okay, remember, if you miss the midterm, even if you get on, if you miss the quiz, even if you log on 5 minutes late, I'm sorry, but that opportunity is gone. Okay, I have to be fair to everybody. All right, there is no requirement that you take the quiz, but there's no downside either. Okay, so I would recommend it to everyone. You're welcome. All right. All right, so without any further ado, again, I'll be reminding you of these in the future. We are going to continue with our study of Chapter 10. And yes, after the quiz, we will be continuing with the class. We don't want to give up any class time. Okay. All right. So what we were looking at last time, we were looking at bonds payable. Okay. Bonds payable are a type of debt financing that a corporation can decide to basically undertake. Okay. Instead of selling bonds to instead of selling stock to the public, the corporation can decide that it's going to have some debt. It's going to issue debt as well. Okay, when you're talking about multinational, huge publicly traded corporations, there's a large amount of capital that they need in order to continue their operations. Okay, now what we spoke of last time is that bonds can basically be issued for 4 different values. Okay, the first price that these bonds are going to be sold for is at face value. That is the easiest one. Okay, that's what you hope for on a quiz and on a midterm, if the bonds are sold at face value. All right, and we're going to talk about that in a moment. Then, and again, if the bonds are sold at face value, it is said that they are sold at 100, okay, or 100% of their face. Okay, then bonds can also be sold, and this is the trickier one, okay, if bonds are sold between interest payment dates. INT. If bonds are sold in between interest payment dates. Okay, certain issues in terms of the record keeping and also of the debt interest. There's certain issues that are going to come up and which are unique to the situation, and we're going to review them. Okay. The next price that bonds could be issued at is bonds could be issued at a discount. Okay, so what happens when bonds are issued at a discount is that bonds are sold at below the face value. So, that would come up if I told you that the bonds were issued at 98. Okay, so if bonds are issued at 98, what does that mean? That means that the bonds are sold at a fraction, at 98% of their face value. Okay, so again, if the bonds, typically they have a $1,000 face value, they're sold in lots of 1,000. If I told you that the bonds were sold at 98, cash to the corporation then received, per bond, they received $980. Okay, so that's the 4th different situation in terms of pricing of the bond. And then if bonds can be sold at a discount, it makes sense that the other extreme could be that bonds are sold at a premium. And issued and sold are the same thing. Here, if the bonds issued at a premium. So if bonds are issued at a premium, whenever you see that they are sold at a value in excess of 100, so let's say I told you these bonds were sold at 101, okay? That means those bonds were sold at a premium. The corporation receives an amount that was greater than the face value of the bonds, okay? So if I told you again that the bonds were sold at 101, since the bond typically has a face value of 1,000, that means that these bonds were sold at a price of $1,010. Okay? All right, so something to keep in mind. Now, from this point on, whenever we come across an issue with bonds, okay, the first thing you're going to say is, all right, which value were these bonds sold at? Were they sold at their face value? Were they sold in between interest payment dates? That's the second situation. Were they sold at a discount, or were they sold at a premium? Okay, so one of those situations is basically going to occur when we're selling bonds. We're going to go over each of these situations independently. Okay, so again, but that's the checklist. You go in your mind, you figure out which situation exists, and then you're going to record the information accordingly. But I want you to remember, okay, is that it's always one, the pricing is always just one of these situations. There's never going to be a combination. Okay, so if bonds are sold between interest dates, okay, that means that these bonds were sold at 100, okay, at their face value, but in addition, the bondholders paid an amount in excess of the face value, but it was sold at 100, and I'll show you what that means in a few moments, okay, because we're going to go over each of these situations independently. Okay, all right, so let's start with the easiest situation. Let's start here with the situation where these bonds are sold at face value. Okay, and how can you tell? How do you know that? Well, what we see here is that on March 1st, Wells Corporation issued $1 million of debt of 6% 20-year bonds payable, and it was dated March 1st. So if these bonds are sold on, since these bonds are sold on an interest payment date, why is this not? Oh. If these bonds are sold on an interest payment date, here March 1st, okay, you know that in that instance, there's no interest that has accrued between interest payment dates. These bonds were issued on an interest payment date. So that's the first checklist. So since it was issued on an interest payment date, okay, we know the first thing is that it's not, these bonds were not issued between interest payment dates, so we can scratch off that alternative. We know this is not a situation that we see here. Okay, then let's read on. The interest is payable semi-annually. That's always going to be our situation. It's always payable semi-annually, and it's payable on March 1st and September 1st. So every 6 months, okay, once these bonds are issued, there's going to be an interest payment made on them. What you have to remember is, remember earlier you were told that the interest payment rate is 6%. Remember, that's an annual rate. Whenever you see interest rates, realize that it's always an annual rate. Okay, so that means on each semi-annual interest payment date, how much interest is the corporation paying to its shareholders? They are paying 3% interest on each interest payment date. Okay, and here now we can go a little further. Assume the bonds are sold at face value, and here they're asking record the issuance of the bonds. Okay, now remember, the corporation is issuing or selling these bonds to the public. Okay, so what is, and I want you to always remember it this way. Okay, March 1st, that's the date of sale. Remember that the face value, this $1 million, okay, that is the face value of the debt. That is the amount that the corporation, regardless of how much this bond issue is sold for, Whatever the contract amount is, that's the amount that the corporation has to pay back in the future. So the face value is always the amount that is credited to bonds payable. Okay, because that's the contractual obligation. So always do that in journal entry first. Okay, that part, the credit part of the journal entry. Even if, okay, so I'll take it a little further. Even if the bonds were sold at a premium, that means the corporation received more cash than the face value, or if the bonds were sold at a discount, okay, where these bonds were sold then less than the face value. Cash will affect the account, which is debited. The cash account, it never affects the bonds payable. Okay, so the full amount of the bond issue, the face amount of the bond issue, is always the amount that gets credited to bonds payable. So always, that's your first journal entry. Remember that part of it, and it'll make your calculations that much easier. Okay. All right, so here we're told that the bonds were issued at face value. Okay, so that makes it easy. We know then the amount of cash, remember, from the corporation's perspective. From the corporation's perspective, the amount of cash that they received was $1 million. So when the corporation receives cash, what happens to cash? Cash is going to be debited. Okay, so on the issue date, on the issue date, on the date the corporation sells these bonds to the public, again, through an underwriter, okay, which we talked about last time. The corporation doesn't want to be responsible for managing these bonds. They're going to have an underwriter, and then the brokers are going to be dealing with the bond issue. But on the date of sale, this is the amount, if they're sold at face. Okay, so that's not so bad, right? That's easy to remember. Okay, remember, always go for the bonds payable first, though. The credit to payable, because it's a debt, right? Debt obligation. All right, so what's the next date in the life of this bond? The next relevant date in the life of this bond, regardless of what price they were sold at. Excellent, Lysander. On the date of interest. Okay, so March 1st is the date of sale. The next relevant date is the first date that interest is going to be paid. And again, interest is paid from the corporation to the bondholders. Okay, so here on September 1st, okay, what is the journal entry? Okay, so we're going to take always, and remember, in the interest calculation is always based on the face value. Okay, so any interest calculation is always based on the face value of the bond. It doesn't matter if I sold it for less or more, it is going to be based on face value. Again, why? Because that's the contractual obligation. The corporation has promised that they're going to pay 6% interest based on the face value of those bonds. Okay, so that's the amount that we're going to calculate interest on. Okay, remember that this is the stated interest rate. Okay, the stated interest rate on those bonds is the contractual obligation the corporation has. Yes, Lysander.
No, I just figured it out. I was gonna ask, why isn't there an entry for payment on March 1st? But I realized that is the next.
Yes, they don't pay. Yes, exactly. So 6 months later, okay, what happens now is those bonds have been outstanding for 6 months. Okay, so what happens 6 months later? The corporation owes the bondholders interest on their investment. Okay, so how do we calculate that? We take the $1 million face value, okay, multiply it by the annual interest rate. But remember, interest is always paid semi-annually. Okay, so since it's paid semi-annually, we're going to multiply that amount by 1/2. Okay, because it's half a year that we're paying interest for. So how much cash, okay, in interest expense is paid from the corporation to the bondholders? Okay, bond interest expense is going to be debited for $30,000. Okay, and then the cash is going to be credited. Remember, always from the perspective of the corporation when you get confused. Okay, all right. So here now they're paying out cash. Now, just as a reminder, okay, we talked about what the four, on an earlier slide, talked about what the four relevant dates are. Remember, there are four different prices a bond can be sold at, okay, and there are four different dates that are relevant in the life of a dividend. I'm sorry, in the life of a bond, four important dates. Okay, so the first day that is important in the life of a bond is obviously on the issue date. That's when the bonds are sold to the public. Okay, and we see here on this one is the first interest payment date. Okay, that's the second significant event in the life of a bond, the first interest payment date. Okay, now, however, all right, what's the next important date in the life of this bond? Okay, and again, we're going to assume always for our purposes when we're talking about bonds, assume that this corporation is on a calendar year basis. Okay, so Mark, why don't we debit bonds payable? Remember, okay, so good question. I'll go back for that one. Okay, remember here in the description of the bonds, see this $1 million, okay? Remember the face amount of the bond? That amount is now basically debt of the corporation, okay, for the next 20 years. Good question, for the next 20 years. So the way we're always going to think of it for our bonds payable is the corporation borrows a lump sum of money. In this instance, it's $1 million on March 1st, 2018. The corporation borrows a lump sum of money of $1 million. That lump sum of money is not going to be paid back to the bondholders until 20 years from now. It's going to be a balloon payment at the end of the bond's life, 20 years. The corporation is not going to make any interim payments back. Okay, so we're not going to have another journal entry that affects this particular bond. Okay, we're not going to have a journal entry that affects this particular bond issue until 2038. Okay, 2030. That's. I'll try to type out from now on. Until 2038, that's the next time that this bond's payable for this issue is going to be affected, the balance in that account, because it's simply going to appear on the balance sheet as a liability for the next 20 years until the corporation makes that balloon payment at the end of its life. Okay, so it's never going to be like an interim payment for our bonds. Okay, so what we're going to have to do. All right, so we were going over, okay, what are the significant dates in the life of a bond? The first one I just mentioned was the date of issue of the bonds. All right, the second date is going to be on the first interest payment date. Okay, now, we're running into a problem now because, again, when is the next relevant date in the life of this bond? Okay, so this is September 1st, 2018. We're on a calendar year basis. Okay, we know that the next interest payment is going to be when? It's going to be on March 1st. Okay, yes, Dante, excellent. Since the next, remember, every March 1st, every September 1st, that's when interest is going to be paid on this bond. Okay, but since they're on a calendar year basis, excellent, Dante, we have to now, at year end, we have to accrue any interest expense, okay, that has accrued since the last interest payment date. So we have to accrue any interest, okay, since the last payment date. Interest, I keep spelling that, interest payment date. Okay, and this is always the tricky part. Okay, again, we're not really going to have any significant obligations after the issue date. Okay, we know that as a matter of course, we're always going to have to pay interest on those two dates. However, this comes up because of the fact that interest is not paid on June 3rd and December 31st, we have to accrue. Okay, now how many months are we going to have to accrue? And this is always, I'm going to tell you, whoever answers this question is going to get it wrong. How many months interest do we have to accrue through December 31st? Nope, not 12. 3 months, that's what everybody, yes, exactly. That's exactly what everybody goes through. What I want you to realize, and they do it intentionally, okay? Here, use your fingers, okay? The last interest payment date was on September 1st. So to get to December 31st, how many months is it? September, October, November, December. Okay, so Mark gets the prize. Yes, 4 months of interest, exactly. 4 months of interest has accrued since the last interest payment date. Okay, so and these are the 3 days in the life of a bond: date of issue, first interest payment date, the accrual of any interest since the last interest payment date. We know again every 6 months we have to pay interest. What is the net beside the interest payment date? What is the next relevant date in the life of a bond? The next relevant date is going to be when the bonds retire, the retirement date. So after the first year, we're just going to have those normal journal entries on the interest payment dates, just recurring. But at the end of the year, we're going to have to accrue the interest as well. Okay, and then 20 years from now, on March 31st, 2038, we have to retire that debt. Okay, so we're going to go through all of that. All right, so this was our first interest payment date, September 1st. Okay, $30,000 interest expense, $30,000 cash payment, no problem. Okay, so now we're going to have to accrue interest on December 31st, and again, that's 4 months later. So what is the journal entry going to be on December 31st? On December 31st, okay, and this is December 31st for the next 20 years, okay? As long as this debt is outstanding, it's the same journal entry on December 31st. So these journal entries, exactly, Denise, excellent point. These journal entries are going to repeat all the way until the bond is actually retired. Excellent, yes. Okay, you're welcome. Okay, so now at year end, what are we going to do? All right. So we know 4 months have basically transpired since the last interest payment dates. So again, we take the face value of these bonds, which is $1 million. That's the contractual amount, okay? Do they get an interest payment? Yes, they do. Good point, Kristen, and I'll get to that. That's a very important point. It's always asked on an exam. In March 31st, 20 years, 2038, do they have to make an interest payment before they retire? And the answer is yes. Okay, excellent question, and we'll get to it in a few minutes. Yes, because the debt had been outstanding since April 1st of the, September 1st of the previous year. So yes, on the retirement date, there always are 2 journal entries. Okay. Okay, so we're taking the face value, contractual value, the stated rate of interest, okay? But here we're prorating the interest. We have to prorate it because we're only accruing 4 months of interest. Okay, remember that when we're just accruing interest, we do not involve cash. So cash is not involved in this journal entry when we're just accruing interest expense. We're just recognizing that, you know what, the corporation owes $20,000 to its bondholders, okay, and we're going to record, we're not going to credit cash, we're going to credit bond interest payable on this day. Okay, all right, and then, all right, what is the next relevant date in the life of this bond? This is December 31st, year 1. Okay, we know it always goes back now. I hope we have a slide for this. Yes, very good. The next one, and again, they made exactly, realize here, Lamia, very good. 2 months. Remember, when we're talking about March 1st, that's really 2 months into the next year, right? Because it's January and February. All right, March has not transpired yet. We accrued 4 months in the previous year. That means, and again, just here, if you have this, make sure you write, this is now the interest payment on March 31st, 2019. Okay, this is the next year. Okay, so, and again, these are going to be the 3 journal entries that are basically recorded every single year. So here on March 1st, remember, whenever you're in doubt, okay, whenever you're in doubt, always go with the cash first. That's usually the best way to calculate it. Okay, so we know that this corporation has to, oops, no, I'm sorry, okay, so we know, again, this is 2019. Okay, so we know that the amount of cash that this corporation has to pay is going to equal $1 million, okay, times the 6%, okay, times 6 months, because now the corporation is accruing interest, I'm sorry, for 6/12. Okay, the corporation is accruing interest now and paying interest for the full 6 months. So that equals $30,000, right? That's the amount of the cash payment. Okay, so always try to figure out the cash first and the rest becomes easier. Now, where did I get this $20,000 of bond interest payable? Okay, so the accrual entry exactly carried over, because remember, when I accrued interest, Lysander, on March 31st, yes, I credited the bond interest payable on that day. So now, when I'm actually paying the amount of interest on Oscar, there you are. Yes, Oscar. Oscar, did you have a question? I think your mic is off. Oscar, where'd you go? Okay, so here, so the amount of cash is 1 million times the 6% times 6/12. Okay, that's the amount of cash the corporation is paying the shareholders. Okay, now realize here, this $20,000 was a reversal, okay, of what we accrued earlier on December 31st. Now we're reversing it, okay, because now we're paying it off. What is the amount of bond interest expense now, which is going to be recognized on March 31st, 2019? It's going to be the difference, which is $10,000. The difference between the cash paid and the amount of interest that was accrued so far. Okay, now again, you could see the difference here. You could just calculate it because it's $10,000. Then if you wanted to prove that answer, you would take the $1 million multiplied by the annual rate, the contractual amount 6%, times 2/12, okay, for this year. And again, the amount of interest that has accrued for this year is bond interest expense. Okay, it's the current bond interest expense for this year. Okay. All right. Now, this is for the year 2019. Okay, everybody get this? Any questions? All right, so these same journal entries are going to take place for the next 20 years. Okay, when interest is paid, March 31st, interest is, I'm sorry, interest paid March 1st, interest paid September 1st, interest accrued December 31st. Same 3 journal entries. Now, however, all right, so they're going to continue. What happens now in the year 2038? 20 years from now, and this answers your question again, Christian. Okay, so what happens on March 31st? Okay, we're going to retire the debt on this day. March 31st, 2038, we're going to make the same journal entry, okay, for bond interest expense, bond interest payable, and credit cash. Same journal entry. Okay. But what's the next, and only on March 1st, 2038. Remember, the full amount, it's a balloon payment that the corporation is going to make to the shareholders. There's no interim payments. Okay. So here, what else? What's the second journal entry that has to be made? Oops, they don't have it here. What is the second journal entry that is made? Kristen, since you brought it up, I'll let you answer the question. What's the second journal entry in 230? Yes, excellent, Christian. We are going to debit bonds payable. We are finally paying off that debt. Okay, so bonds payable is going to be debited for the full amount of the debt, which is $1 million. Okay, and now, and exactly, and the second journal entry, excellent, is going to be a credit to cash, okay, for the $1 million as well. Excellent. Okay, on the date of retirement, on the date of maturity of these bonds. So remember, regardless, now we're going to get into some more complicated calculations. Regardless of the amount that the bonds are sold at, okay, on the date of maturity, you're always going to retire the face value of the bonds, because that's how much the corporation has to pay you. That's really the contractual amount that the bonds have to be, that the bondholders are going to be reimbursed for. Okay. So now I'm going to make it tricky. Okay. If I asked you, and these are for those of you who are here today, you're going to be at an advantage. Okay. So if I asked you, all right, now be very careful. Okay. If I asked you in the year 2000 and the first year, 2018, in 2018, okay, or actually any year thereafter also, what is the amount of bond interest expense that is recorded on the books and records of the corporation? What is the amount of the bond, I'm having trouble spelling interest, bond interest expense, bond interest expense, okay, that is recorded annually? Bond interest expense, okay, $10,000. Anybody else? $20,000. Don't forget December 31st. You're almost there. Not 60,000. All right, right in between there. All right, so the bond interest expense. All right, so let's look at this. We see here, okay, that on March 1st, what is the amount of, okay, so this is for in year one. I'm sorry, so let's go back. This is in year one, 2018. Okay, so what is the amount of bond interest expense? Let's go back. Almost there. Almost there. Okay, bond interest expense. All right, so let's go back to some of those slides. Okay, so on September 1st, okay, bond interest expense, sorry, on September 1st, what was the amount of bond, I'm sorry, on September 1st, what was the amount of bond interest expense that was recorded? $30,000, right? Okay, so that's the first one. But remember, we had that adjusting journal entry at December 31st. How much bond interest expense? The bond interest expense that is recorded on December 31st equals $20,000. So at this point, the $30,000 interest expense that is recorded, right? Exactly, $40,000. So the amount of bond interest expense is $30,000 plus the $10,000. Okay, that's the amount. And I would write this down if I were you. The bond interest expense in year one is $40,000. Okay. Now, if I asked you how much cash, okay, 10,000, because on this, I'm sorry, bonds. I'm sorry, did I make a mistake here? The amount of bond interest expense. All right, sorry. So the amount of bond interest expense is $30,000. Excuse me. So it was $30,000 on September 1st. It's so tricky. I got tricked. $30,000 on December 31st. It's $20,000. Excuse me. So it's $50,000. You're right. I tricked you. All right. So $30,000 plus the $20,000 in bond interest expense on December 31st. That equals the amount of bond interest expense in year one, very good, of $50,000. Why is it not? Because here it's $20,000. It's only for 4 months that we're accruing in year one, so it's only $20,000. Okay. Now, what if I asked you what is the amount of cash? Okay, and this is the difference. How much cash was paid for interest in 2018? How much cash was paid? Yes, very good, more. Only $30,000. Very good. Okay, and now you see here a significant difference. The amount of bond interest expense in year one, okay, that was recorded was $50,000, but we only paid $30,000 cash. Okay, why is it $30,000? Because the only time, remember, the other interest payment date in year 2018, do we pay cash on December 31st? Gabrielle, did we pay cash? No. Okay, so that means that the amount of cash, though, that was paid for interest expense in year one was only $30,000. Okay, good. Oh, it's okay. It's a good question. All right, that's the type of tricky question that I'm going to have on the midterm. Okay, so what you have to do when you have something like this, always just go back to the journal entries. Okay, oh, you're welcome. All right, and you see here in year one, it's going to be a little different because of the fact that you always accrue at year end, and that never involves cash. Good. All right, so now this is what you hope for on an exam when bonds are issued at face value. Okay, now let's go to the next circumstance. Okay, everybody ready? It's a little tricky. Okay, so the next situation, the second price that bonds can be paid at, if bonds are sold between interest payment dates, okay, what has to happen? And I'll explain it first. If bonds are sold by the corporation, the first time I'm selling it, let's say, like just in the last situation, what were the interest payment dates? We know the stated interest payment dates were on March 1st, and then the second interest payment date is going to be on September 1st. Every year throughout this bond's life, this is what the interest payment dates are. And we also know how on December 31st, there's always going to be an accrual. Okay, and again, the dates that interest can be paid are different. This is just the situation that we're dealing with here. Now, here, the second one, when bonds are issued between interest payment dates, this affects the sales price. Okay, why is the sales price affected? Because if you're told, okay, that the date of issuance is ever not an interest payment date. Okay, so here in this situation, the issue date was on May 1st. Okay, so what happens, right? The bonds were issued on May 1st. That was 2 months after, okay, 2 months late. It was after an interest payment date. Okay, so when bonds are issued on a non-interest paying date, the amount of interest that accrued between March 1st, the amount of interest that accrued between March 1st and May 1st, okay, that is called accrued interest. All right, so what happens now when the bonds are sold by the corporation after an interest payment date? Those 2 months of interest, okay, I know everybody is going to have a problem with this and say, wait a minute, it doesn't really make sense. How much am I going to make you, the bondholders, pay me if the face value of these bonds, let's go back to the original example, if the face value of these bonds are $1 million, okay, on May 1st, what am I going to do? I'm going to require that you give me the face value of the bonds, which is $1 million. Okay, but what else am I going to do? I'm going to also require that, yes, you have to also pay me for 2 months of interest. Very good, Kristen. Okay, in addition to the $1 million, you have to pay me for 2 months of interest. Okay, and you're going to say, wait a minute, that really doesn't make sense. Why am I going to do this? Okay, and this is just the industry standard, and you'll see why it makes sense. Because then the reason the corporation does this is so that on September 1st, which is the first interest payment date, okay, how much interest expense am I going, how much cash am I going to pay to my shareholders? I'm going to pay you the full $30,000. Okay, I want to make a full, exactly 6-month payment to you of $30,000. Okay, I don't want to worry about, okay, you know, you bought it on this day, the other person bought it on another day. Over the life of this bond, I always want to pay $30,000 cash on every interest payment date, just for ease of bookkeeping, and just because really this is what the market price of those bonds are. Because 2 months of interest has accrued, okay, between March 1st, which is the interest payment date, and the actual date of issue, which is May 1st. So I'm going to make you pay me. I'm going to make you prepay me for those 2 months of interest that have accrued, and then on September 1st, the first interest payment day, I'm going to give that money back to you. Okay, and now Joshua, is that why bonds are seen as a safe investment? Because there is a guaranteed, yes. Okay, yes, and in this instance, it's guaranteed because you prepaid it. Yes. Now, Joshua, in the complicated world, okay, yes, they're considered a safe investment because corporations must pay the amount of interest that they owe, okay, on a semi-annual basis. Okay, but what happens if a corporation, for some reason, and it does happen, if a corporation does not have enough cash available, okay, they may not be able to pay the interest. But again, in that instance, that's when the corporation basically has to file either for receivership, or it has to basically reconfigure, okay, or refinance their debt. But in a world where the corporation is successful, it's not, interest is not like dividends. Interest is not optional, that it has to be the board of directors. A corporation has to pay interest unless they are running into financial difficulties. Okay, and then again, of course, they may not be able to, but then that goes into restructuring, bankruptcy, insolvency, things of that nature. Okay, so I just want to qualify that opinion as to, you know, they have to pay interest. If they can't, then it may be insolvent, and other situations have to take place. Okay, all right. So basically, to restate what I just said, so the selling price of a bond is always calculated in here, what the present value, or here for our purposes, since we're not using annuity tables, we're always going to calculate the price of the bond, okay, as the stated value of the bond or the face value of the bond. But if the bonds are paid between interest payment dates, the corporation is also going to require the bondholders pay the accrued interest since the last interest payment date. Okay? All right, so let's go through that calculation. Can a corporation just leave off the interest payment because they can't pay it? And then, no, they're not able to do that. In instances like that, no, it's a legal requirement. If there's a stated interest rate, it's a legally enforced requirement that they pay interest on that day. Okay, again, if it seems that that's a legal requirement, they can't just make it up like dividends, like cumulative dividends. It's not like that. Interest must be paid on that day. Okay, or otherwise there's a threat of insolvency for the corporation. They have to take certain legal actions. SEC has to be notified, and other actions have to take place. Okay, so it's not like a cumulative dividend, but good question. Okay. All right, so let's see what I'm talking about. The best way to do it is with an example. Okay, and remember, it's always going to be, you have that list of 4 different situations. Bonds are issued at par, or here they're issued between interest payment dates, or bonds are sold at a discount, or they're sold at a premium. Only one of those pricing scenarios are going to take place. Okay, so when you attach a problem, and that's why the exercises are great in this chapter. We're not going to get to them today, but the exercises are great because it really will spell out the differences in all of these situations. Okay, so here, now, same corporation, they issue $1 million. That's the stated amount of the debt at 6% interest. That's the amount of annual interest the corporation has to pay. Okay, so here, again, the bonds were issued, okay, at their face value, all right? And that's always going to be the situation here. The problem here is that the interest payment dates, again, are on the required interest payment dates are on March 1st and September 1st. Oh, Rajiv, sorry. Always go to the classroom with this date on it. Okay, never. There's another classroom. I don't know why it exists at the top, but the classes are taped. Sorry about that, Rajiv. Okay, so always go to the lower on the lower part of the page for Blackboard Collaborate. Okay. So the interest payment dates are March 1st and September 1st. You're always going to be told that. But what happens here is the corporation decided not to sell the bonds on either of the interest payment dates. They sold them 2 months later in year 1 on May 1st. Okay, so what happened? 2 months of interest has accrued on these bonds. Okay, 2 months of interest has accrued since March 1st, because that's the stated interest payment date. So what am I going to require? Okay, I'm going to require that in addition to charging you what the face value of these bonds are, in addition to the $1 million that you're going to give me, I am also going to require that you prepay to me for those 2 months of interest that have transpired between March 1st through May 1st. Okay, you're going to give me an additional $10,000 in cash. Okay, and again, that's just the industry standard. Okay, and this would also happen if you were selling, let's say the bonds were in, Joshua owned one bond, and Rajiv, I'm going to pick on you since you just arrived, you were buying the bond. If you, as the seller of a bond and buyer of a bond, were buying and selling this bond between interest payment dates, Joshua, you would also require that Rajiv pay you for that accrued interest between those 2 days anyway, right? Because you're really entitled to the interest. You're not, Jason is just not going to, Joshua, I'm sorry, is not just going to sell the bond for the face value. You're going to make Rajiv pay for those 2 months of accrued interest, because Rajiv is going to receive the full 6 months on September 1st. Okay, so that's the reason why 2 months of interest has accrued since the legal interest payment date. So here, since the bonds were just sold, I'm going to require that the bondholders give me an additional $10,000 in cash. But look, is that $10,000 that the bondholders are giving to me, is that revenue to my corporation? Is that revenue to Wells Corporation when you prepay $10,000 of interest? No. Very good, Denise. It's not very good, Kristen. This is not revenue. That $10,000 is not revenue. It's a bond interest payable to the corporation, because they're only holding on to it. They really owe it to the bondholders. And when are they going to pay it back? That $10,000 is going to be paid back to the bondholders on the first interest payment date, which is September 1st. Okay, and then I saw a question here. So Jason, when calculating accrued interest, you have to use the 6% rate instead of the 3%. So here, no. Here again, you could have used the 3% interest, and then you just would have multiplied, because the 3% is semi-annual, then you just will multiplied it by 2 over, I'm sorry, if you made this 3% interest, you just would have multiplied it by 2 over 6. Okay, but here they wanted to show you how you use the annual interest rate. So if it's the annual interest rate, it's 2 over 12. Does that make sense? Because Jason, the 6% is the annual interest rate. The semi-annual interest rate is 3%. So here they just did it so you could see the 2 months of interest that has accrued. You could have used either, whichever calculation you want. Okay, so now, ta-da! We know the next relevant date. It's the date of issue is the first important date in the life of the bond. That's what we have here. The next important date in the life of a bond is the first interest payment date. So what am I going to give to my bondholders on the first interest payment date? See this bond interest payable? What am I going to do? I'm going to give it back to you. Okay, so on the first interest payment date, which is on September 1st, and again here they made, oh good, that's right, on September 1st, no, this is where they made the mistake. Please make sure in your notes, this is incorrect. It should be September 1st. The book made a mistake with this. On September 1st, what amount, again, and whenever you're in doubt, go with the contract amounts. You know that I'm the corporation. I am required to pay you 3% interest on each interest payment date. I have to pay you 3% interest in terms of cash. So get the cash credit. Remember, I'm paying you the cash, so cash is going to be credited on the books and records of the corporation. Okay, so cash is credited here, but remember, you prepaid me $10,000 for that period from 3/1. From 3/1 through April 1st. So what happens now on September 1st? I'm just giving you back that cash that you prepaid me. So really, what is my interest? What is my interest expense? The corporation's interest expense was reduced by $10,000. Okay, because really, they only had to pay for 4 months of interest, not the full 6 months. Okay, it is offset by the 2 months. Okay, and does that make sense? I want you to think of it conceptually. Yes, it does make sense, because remember, the corporation only had the debt outstanding. Since they sold it 2 months late, the debt was only outstanding on the books and records of the corporation from 5/1, on the date of issue, through 9/1. So for the period 5/1 through 9/1, that's only 4 months. I'm not going to pay you for the full, my bondholders, I'm not going to pay you for 6 months of interest when you only loaned me the money for 4 months. Okay, so just to make record keeping more accurate, what are we doing? I'm making you prepay me for those 2 months, okay, for March 1st through May 1st. Okay, I'm making you prepay me the cash. It's not revenue to me, because what do I have to do 4 months later? I have to give it back to you 4 months later. And in addition, I'm going to give you the 4 months that I have accrued of interest. I'm going to be paying you for that 4 months at the same time. Okay? Questions? Okay? The wonderful thing, okay, and I want you to realize this, okay, think through it. The nice thing when bonds are issued between interest payment dates, it's only the first interest payment date that is affected. Okay, only this day, the September 1st of the first year, that's the only interest payment date that really changes. What's the next relevant date in the life of this bond? Okay, we know that the next significant date in the life of this bond is going to be when? On 12/31, okay, 2018. Okay, but what's the nice thing? Okay, very good, Christian, at year end. So what's the journal entry now at year end? Okay, we know that I'm going to have to debit bond interest expense. And here, again, this is the accrual. Bond interest expense. All right. What's the amount of bond interest expense that is going to be debited on December 31st? Okay. $20,000. Very good. Very good, Denise Gerson. $20,000. And how many months is that for? Because that's for the 4 months of interest expense. Excellent. Okay. And then what gets credited here? Denise, which account gets credited here on December 31st? Is it cash? Excellent. Okay. Interest expense payable. Interest expense payable. Remember, cash does not exchange hands at the end of the year. It's merely an adjusting journal entry. And the nice thing, this is the same journal entry that I made when the bonds were issued at face value also. Okay, this is the same journal entry. When there's accrued interest, it only affects the first interest payment date. All other journal entries go back to as if the bonds were issued at face value. Okay, and that's the nice thing. We go back again. The next journal entry is on March 31st. Okay, the journal entry that's made on March 31st. Okay, 2019. March 31st, 2019. Goes back to the same journal entry as if the bonds were paid. I'll even show you here. After the first interest payment date, which was on March 1st. I'm sorry, not March 1st, on September 1st. Look what happens. Same journal entry now as if the bonds were sold at par. Same journal entry. I debit bond interest expense, credit bond interest payable. Now, because now it goes back. I paid you back the interest that I had to on that first interest payment date. All the rest of the journal entries now go back to normal. Okay, so December 31st, here, this would be the journal entry. Okay, December 31st, 2018. Again, next journal entry would be on March 1st, 2019. Sorry, this is here, March 1st, 2019. I can make this a 9. Again, same journal entry as if the bonds were sold at face value. Same journal entry on March 1st. Okay, and September 1st, again, which is the next interest payment date, would be the same journal entry as if they were paid, as if they were sold at face. Okay, so what does that mean? That means that when bonds are sold between interest payment dates, the amount that's accrued since the last payment date, okay, here, between March 1st and May 1st, okay, whatever the number of months that have transpired, that's the amount of interest that is going to be accrued. Okay, and what am I going to require? The corporation's going to require that you prepay me that amount. Okay, and here in this instance, it was $10,000. So you're always, so another point, if bonds are sold between interest payment days, good multiple choice question, what amount am I going to require that my bondholders pay me? Again, my bondholders are going to pay me an amount in cash greater than the face value. Okay, so if bonds are sold between interest payment days, how much cash are you going to pay me as the bondholder? You're going to pay me for an amount that is greater than the face value. Okay, greater than the $1 million. Okay, because I'm going to ask that you also pay me the amount of interest that has accrued between those 2 days. Okay, and it's really just what happens now. I'm going to pay it back to you on the next interest payment date. Okay, which is September 1st. September 1st, 2018. Okay. Everybody's good with this? Again, I know it's a little tricky. Okay, but we're going to go over exercises that really clarify. So again, when you see bonds payable, those first, we're halfway through. Okay. When you see bonds payable, you're going to say in your mind, okay, were these bonds issued at face or were they issued between interest payment dates? You're going to know it immediately from the description of the problem. You're always going to be able to tell immediately which of the four situations exist, and you're also going to know what the journal entries are, why they're different. Okay. All right, so we finished with two of those situations now. All right, now we're going to move on and we're going to talk about what happens, okay, when the selling price of the bond is different than the face value and it's not because of accrued interest. Okay, so in these two situations, the amount of cash that the bonds are sold for is different than what the face value is. Okay, and these situations are not due to accrued interest. And you can always tell the difference immediately. Okay, so these situations that we're talking about now, these are not circumstances where there's accrued interest because the bonds are sold on a coupon on the interest payment date. Okay, if the bonds are sold on an interest payment date, you know that and the bond and it's sold at a different value than the face, you know that it's a different situation that exists. Okay, all right. So in this instance, let's think about this. To determine the price of the bond. Now, for your purposes, you're always going to be told what the face value is and the price that these bonds are sold at. Okay, we're not going to use the amortization tables, so you always have to be told this information. Okay, so let's think about this. Let's think about an instance where the stated value of a bond, all right, and again, you would be given all of this. If the stated interest rate of a bond, let's say, is 8%. Okay, so if on the bond it says that the stated interest rate is 8%. Okay, but let's say that on this date, okay, the market rate of interest, okay, if on this date the market rate of interest for a similar bond, that is for a bond with a similar risk rating, okay, if the market rate of interest on this same day is only 6%. Okay, remember that this amount here, the stated rate of interest, okay, that's the legal obligation. Okay, whatever the stated rate of interest is on the bond, that's the legal obligation. The corporation must pay 4%, okay, every interest payment day. Okay, so if the stated rate of interest is 8%, the corporation must pay 4% every interest payment day. Okay, but let's say on the date of issue, on the date of, remember, because bonds sell, bonds also actively trade on bond exchanges. Let's say that for similar corporations, the market rate of interest on the same day, the day the bonds are issued, is only 6%. So that means other corporations are paying interest on their bonds of 6%, but the contractual rate of interest on this corporation's bonds are 8%. Okay? Do you think there's ever any situation where a corporation is going to pay you 8% when really, based on market conditions, they really only have to pay you 6%? Do you think that ever happens? A corporation is never ever going to agree to do that? No. Very good. So what is the corporation going to require? In a situation like this, when the stated rate of interest is greater than the market value, the bonds are going to be sold at a premium. Okay, and what does that mean? That basically means that the cash received is going from the bondholders is going to be greater than the amount of face value of the bonds. Okay, now, okay, so if these bonds, let's say it's a million, we'll always go back to that $1 million bond issue. In actuality, usually if a corporation issues bonds payable, it's for an amount much greater than just the $1 million. You know, it would be 20 million, 30 million, 50 million, whatever. But here, for simplicity, we're going to say these bonds are sold at $1 million. The face value is $1 million. So what is the corporation going to do? The only way the corporation is going to issue this debt, okay, is that the corporation is going to, bonds are sold by the corporation at a premium, okay, which is a value which is greater, okay, a value which is greater than the face value of the bonds, okay. When bonds are sold at a premium, why does the corporation do that? Because effectively, the effective interest rate of the bonds is decreased. If I'm requiring that you pay me more than the face value, the effective interest rate of the bonds is lowered. Okay, because I'm making you pay more for them up front. Okay, I'm not going to just accept $1 million for these bonds. In this instance, an example, let's say these bonds, if bonds are ever sold at greater than 100%, or if they're sold for greater than 100, okay, and an example here would be if you're told that the bonds are sold at 101 or 102, okay, 101 or, here, let me write it here, 101 or 102. Okay, we know that those bonds are sold at 101% or 102% of their face value. Okay, because of the fact that I'm requiring that you pay me above the face value, what does that do to the effective interest rate? That means I'm not really paying you 8% because you gave me more money up front. Okay, what am I doing? I'm effectively lowering the amount of interest that I'm paying to you by 2%. Is there a maximum amount the corporate? Not really. It's whatever, basically, Christian, good question. Typically, it's going to be based on whatever the existing market conditions are. So for our purposes, it'll either be 101, 102, or 103 maximum, really. Okay, so there's no maximum, but again, for our purposes, it's always going to be close. You're not going to have that much of a sway between the stated interest rate and the market rate. It'll be within those percentages. Okay, so good question. So boom, as soon as you read a question and you see the bonds are sold at 101 or 102, what goes off in your mind? Okay, I know these bonds were sold at a premium. You're welcome. And that means that I required the bondholders to pay me more upfront. Okay. Then the second situation, when bonds are sold at their face value. Okay. If the stated rate of interest equals the market rate of interest. Okay. So the stated rate on the bonds is, let's say, 8%. Okay, then those bonds are sold at 100. Those bonds are going to be sold at $1 million, or whatever the rate is. Bonds are going to be sold at 100, which is going to equal the face value of those bonds. Okay, and that basically means that the stated rate of interest equals the market rate of interest. Okay, so basically you're going to receive, the corporation is going to receive the face value for the bonds. And we're going to go over, well, we've gone over the face value. The bonds are sold at face value. We've gone over that already. We spend some time now going over premiums and discounts. Corporations receive face value. It's whenever basically the market rate of interest is different from the stated rate of interest on those bonds, that's when difficulties come up and you have to read either the corporation is going to sell those bonds at a premium or at a discount. Okay, so let's take the last situation here. Okay, we come across a condition and these bonds basically are sold, but the stated rate of interest is below the market rate. Okay, so let's say here in this instance, the stated rate of interest, again, let's say it's 8%. Let's go with that. It's the same 8% on these bonds. Okay, but in this situation, again, that's the legal interest rate. That's how much the corporation must pay annually, okay, to the bondholders. RAT. That's how much they're legally required to pay. But let's say on that day, okay, when those bonds are issued, the market rate of interest, that is for bonds issued by corporations with a similar risk rating, those bonds are basically offering a 10% interest rate. Okay, now let's think of it from the bondholder's point of view. Is there ever going to be, and when you're going to buy a bond and say, oh, you know what, all other the market rate of bonds, the effective rate of interest on the bonds for similarly risk bonds, they're offering 10% interest, but the amount that these bonds, the new bond issue, they're offering only 8% interest, okay, as their interest rate on this particular day. Is there ever going, since you're a seasoned investor, is there ever going to be a situation where you're willing to accept less interest than what market conditions bear? Okay, and your answer is going to be, are you ever going to accept less interest than what comparable organizations are offering? And the answer is no. Why would you, right? You don't have any vested interest in this company. So in order to entice the bondholders to buy these bonds, what's going to have to happen? They're going to have to sell at below the par value or the face value. Par value of the bonds, or sell below 100. Okay, and these would be situations where you see that these bonds are sold at 99 or 98. Those are typically the percentages. The bonds are not going to sell at 100 because the stated rate of interest is below the market rate of interest. So whenever that happens, the corporation, if they want to sell that debt, they're going to have to agree to receive less from the bondholders than 100%. Okay, right? So if we're good with that, let's move forward. Okay, everybody ready? Okay, so the first situation that we're going to deal with is when bonds are sold at a discount. Okay, how can you tell that a bond is sold at a discount? All right, immediately, okay, so it's again the same corporation, Wells Corporation. They issue bonds on March 1st. Oops, sorry. They issue bonds on March 1st, and we're told here the interest payment dates are 9/1 and 3/1. So March 1st is an interest payment date, so we know that there's no accrued interest, right? Cross that alternative off. But we're told here that the principal amount of the debt is $1 million. We see here that the issue price is below 100. Okay, because why? They're receiving less than 100% of the face value. So in this instance, you would be told that these bonds were sold at 97 or 97% of their face value. Now remember, regardless of the selling price, the corporation has to pay 6% interest per annum. Okay, it's the annual interest rate, And we also know that since they're paying the interest semi-annually, we know that they're paying 3%. Okay, each September 1st and March 1st. And we know these bonds are they basically have a 20-year life. They'd be outstanding. And we know for our purposes that that maturity is always going to be for the full face value 20 years from now. Okay, so let's just think, how much cash did the corporation receive? We know that the face value is $1 million. We're told here that they only received $970,000. So we know these bonds were sold at a $30,000 discount. Okay, so does the interest rate play a role in this calculation? Whenever you do, okay, whenever you do an interest rate calculation, and Joshua, a good question, I want everybody to remember this. Whenever you do an interest rate calculation, it's always based on the face value of the bonds and the stated interest rate. So regardless of how much I sold the bonds for, the legal amount the corporation has to pay the bondholders, I have to pay you 3% interest on the face value of those bonds. Okay? So let's see it. But here you know that since these bonds were sold at a discount, okay, so Joshua, since the stated interest rate is 6%, but I'm selling these bonds at a discount, what does that do to the effective interest rate? Is the effective interest rate higher or lower because I sold these bonds at a discount? Lower? Not lower. Remember, I received, okay, so I have to pay, remember, I have to pay you back $1 million in the future, right? The amount of the full face value in 20 years. I have to pay you $1 million back, but I accepted only $970,000 from you now. Okay, so I know I have to pay you 6% interest each year, but the fact that I received less from you up front, okay, when bonds are issued at a discount, okay, what happens to okay, so Kareem, what happens to the effective rate of interest? Is the effective rate of interest higher or lower than the stated rate? When bonds are issued, higher. Very good, Joshua. Whenever, very good, Denise. When bonds are sold at a discount, okay, the effective rate of interest is higher than the stated rate of interest. Okay, so when bonds are issued at a discount, okay, what happens is since I accepted $970 cash from you for each bond versus the $1,000 face value, okay, what happens to that $30? That basically is since I know I have to pay you back $1,000 per share 20 years from now. Since I sold it at a discount, what does that do? That raises the effective rate of interest that I'm paying. I still have to pay you 3% every interest payment date, but in addition, I'm going to write off that $30 difference between the stated value that the bonds were sold that are issued at and the amount of cash that I received, the $30 difference per bond. I'm going to have to write that off as additional interest expense over the next 20 years, over the life of the bond. So whenever bonds are issued at a price whenever bonds are issued at a discount always, okay, this is the rule, and it'll help you with the calculation. The discount always, bond sold discount, always raise the effective rate of interest to a higher rate. We won't know what the effective rate is because we're not using the tables. What you have to remember is that when bonds are sold at a discount, it raises the effective interest rate. And you're going to see why in a minute when we go through the journal entries. Okay, just write that down so you know the rule. And now we're going to go through the journal entries. Okay, everybody ready? Okay, so we know this is the situation. So here, okay, we know, remember, the first thing, whenever there's a bond issue, the first thing you're always going to write is the credit to bonds payable. Because remember, the credit to bonds payable is always for the, regardless of what the bonds are sold for, that is always the face value of the bonds. So get rid of that first. You're always going to credit on the date of issue bonds payable for the full amount. Okay, but now what else do we know? Based on the information you're given, what was the amount of cash that the corporation received? Only $970,000, right? Because these bonds were sold at 97. Okay, we know that only $970,000 in cash was received. So wait a minute, our debits don't equal our credits. Okay, so what does that mean? That means we have to debit discount on bonds payable for $30,000. Okay, all right. Now, we know that when these bonds mature 20 years from now, okay, how much do I have to pay back to my bondholders? I have to pay them back for the $1 million, right? That's the face value. So what does this $30,000 basically do? Since I accepted $30,000 less in cash from you, this $30,000 has to basically be amortized, okay, or written off. Okay, this discount on bonds payable is going to be amortized to interest expense. Okay, that $30,000 is going to be amortized to interest expense over the life of the bond. Okay, very, very important. So that $30,000 discount is amortized to interest expense over the life of the bond. Okay, so what does that mean? That means that every time the corporation pays interest on these bonds, a little piece of that $30,000 is going to be amortized as well. Okay, so let's think about it. We see the amount of the discount is $30,000, right? Now, we know this bond has how many years? How long is this bond going to be outstanding? 20 years, right? And you have to always be given this information, all right? So we're going to write off this discount on bonds payable over the next 20 years, okay? But how many interest payments are there every year? How many interest payments are there every year? 2. Very good, Casey, Denise. Very good. 2. So we're going to write off that $30,000 by $30,000 divided by 40. So that means every 6 months we are going to write off $760,000 of that discount on bonds payable. Okay, so everybody see that you always take the amount of the discount divided by the number of interest payments that are going to be made over the life of this bond, and that gives us $760. That's additional bond interest expense that's going to be amortized every interest payment. Okay, so remember, when bonds are sold at a discount, this raises the effective interest rate. So the bonds are sold on March 1st. Okay, and this is March 1st, 2018. What's the next important day in the life of this bond? Okay, when's the next time we can anticipate that we're going to have to do, the corporation is going to have to make a journal entry for this bond? September 1st. Excellent, Christian. On September 1st, which is the first interest payment date. Excellent, Denise. All right, so this is March 1st, date of issue. Let's go now to March 1st, okay? Oh, okay, so before we get to March 1st, I just want to show you now, what would this bond issue look like on the date of issue? If I looked at the balance sheet, what would this look like on the balance sheet? We know the face amount of the bonds, because this really is the liability, the whole $1 million, that is going to show under the bonds payable. But what else are we going to see? Only on the date of issue, okay? The amount of the discount is going to be for the full $30,000, okay? That wasn't paid. Remember, that was the amount of the discount. So what is the carrying value of the bond? The carrying value of the bond on the date of issue is $970,000. Okay, so what's going to happen over the life of this bond? What's going to happen to the discount? Okay, remember I said that over the life of the bond, the discount is going to be amortized. So over the life of the bond, the amount of the discount is going to be reduced. Okay, so the discount is going to be reduced over the life of the bond. Okay, and that is in each interest payment date. The discount is going to be reduced. So that means what happens to the carrying value of the bond over its life? If we know the face value, if we know that the discount is going to be reduced, what happens to the carrying value of the bond? The carrying value is going to increase over the life of the bond. Okay, because we see here, we have the face value, we see the discount equals $30,000. It's being subtracted from the face value of the bonds. On the issue date, it's the full $30,000. The carrying value is $970,000. We're going to see each interest payment date, we're reducing the amount of the discount. Okay, and that's how we raise the effective rate of interest with a discount. Okay, so each interest payment day, the amount of the discount is going to decrease. So, and therefore the carrying value is going to then increase. Okay, so what is the carrying value of these bonds going to be on the date of maturity? Okay, at maturity, what is the carrying value of these bonds going to equal? Anyone? At maturity, exact, Casey, excellent. It's going to equal $1 million. Very good. Okay, so the carrying value of the bond is going to keep increasing over its life. Okay, because we know that at maturity, the corporation, regardless of the price that the bonds were sold at, we know that at maturity, the corporation has to pay back the full $1 million. Okay, so we're going to have to keep reducing this discount. Okay, how are we going to reduce it? Through the journal entries. Okay, now let's get back to the journal entries. We know that I mentioned that the next journal entry, or Christian and Denise mentioned that the next journal entry is on September 1st, which is the first interest payment date. Okay, what we're going to do on each interest payment date is that we're going to amortize the discount over the life of the bond. Okay, so as I did before, we're always going to use multiple choice question for us, maybe high likelihood. All right, what method are we going to use to write off our bond discount? We're always going to use the straight line method. We're not going to use any accelerated method. And the straight line method just says we're going to take the amount of the discount, which is $30,000. We're going to divide it by the total number of payments. Now remember, it's 40 payments because it's the 20-year life times 2. Okay, it's not an annual one. It's 20 times 2, which is 40 periods. So Every interest payment, we're going to amortize $760 worth of the discount. Okay, remember that when we recorded the discount, okay, when the bonds were issued, so everybody has this? All right, let's go back to the journal entry on the date of issue. When the bonds were issued, okay, on this date, you see here, oops, on the date of issue, what did we do to the discount? We debited the amount of the discount, right? So you know whenever you're going to amortize the discount, okay, we're going to write off the amount of that discount. We're going to decrease it. So what are we going to do whenever we amortize the discount? Remember, you always have to do the opposite. So you're going to credit the discount whenever you're amortizing it. You have to do the opposite of what the existing balance is. Okay, so we have to reduce it. So how do we actually reduce it? We know we're going to reduce it by $970. I'm sorry, by $750 on the first interest payment date, which is September 1st. So, okay, and the way I want you to do this, all right, when bonds are issued at a discount or premium, okay, since we're not using the tables, I want you always to work a little bit backwards. So what do we know? We know that on the payment date of September 1st, what are we sure of? We know that the corporation owes the shareholders $1 million times 6% times 1/2, because 6 months have transpired. The $1 million times the 6% times 1/2. So how much do I, the corporation, have to pay you, the bondholders? I know, or we know that I have to pay you $30,000. Okay, because that's the amount of cash. That's the stated amount, right? This is the stated amount of the bond. That's always the amount of cash that has to exchange hands. I have to pay you that amount of interest regardless of what I sold the bonds to you at. Okay, but remember what I said earlier, I sold these bonds at less than the face value. Okay, so what did I do? I took the discount, the total discount of $30,000. Okay, remember the amount of that discount, originally that was a debit, right? I debited that amount when I first recorded it in the journal entry. Okay, so now when I'm writing off that $750, that $30,000 discount over the 40 periods, all right, remember, since it was a debit when it was recorded, when I'm amortizing it, it must be credited. It always has to, when I amortize something, it's always the opposite of the existing balance. Okay, so now what does that mean? What's the amount of interest expense that I, the corporation, am going to record? I'm giving you the $30,000 cash. But in addition, since I accepted less, okay, than the face value, what does this $750 do to the effective amount of interest? Because I sold the bonds at a discount, what is the effective rate of interest? Is it actually higher than 6% or lower than 6%? If I sell the bonds at a discount, look what's happening here. I'm writing off that subsidy. Excellent, guys, excellent. The effective rate of interest, because I sold the bonds at a discount, the effective rate is actually higher than the 6%. Now, please remember, make a note in the details here. Always start when it's a discount or a premium. Okay, when it's an interest payment date, always start with the cash amount that exchanges hands. The cash amount that I'm paying to the bondholder. Then you're going to amortize the discount. So here, when I'm figuring out the amount of bond interest expense, I'm adding these two amounts together. There's no other way. This amount is always going to be a sum. There's no way you can calculate this amount any other way. It's always going to just have to be a sum between these two credits, okay? Because we're not using the tables, All right. It's always, we're not going to, there's no other way. So you really have to back into the bond interest expense for a discount and a premium. Okay. Because remember, if I sold these bonds at face value, what would the bond interest be? If these bonds were sold at face, okay, what is the amount of interest expense I would have recorded? I would have recorded, and I mentioned it earlier. What would the interest expense be if I sold these bonds at face value? The interest expense on the first interest payment date? $30,000. Excellent, Christian. Very good. If I sold these bonds at face value, the amount of interest expense would have been $30,000 on this day. Exactly, Denise. But the fact that I sold them at a discount and I'm amortizing that discount, it raises the amount of interest expense. Okay, excellent. And it takes a while to absorb, I know, but that's why we're going through it slowly. Okay, so here you could see when bonds are sold at a discount, it raises the effective interest rate. So, okay, does everybody have this? All right, so on the date, okay, so let's just go back to the previous slide. On the date, okay, if this was prepared as of 9/1/18, okay, 9/1, okay, and again, this is the balance sheet, okay. If this balance sheet was prepared as of 9/1, what would have changed? This stays the same. The face value of the bonds, that remains the same. Well, what happens to this $30,000 as of 9/1? Now, what is the amount that is going to be recorded? What's the remaining discount on bonds payable? The remaining balance is going to be $29,250. Okay, that's the remaining amount of the bonds. Why? Because that $750 difference, remember, we just reduced the remaining discount on bonds payable. Okay, so now the remaining discount is $29,250. So what is the remaining? What is the carrying value now on this day? Is it going to be higher or is it going to be lower? It's going to be higher because remember, we're amortizing the discount. So what is the carrying value of those bonds after the first interest payment date? It is going to be $970,750. Okay. It's going to increase. And what is it increasing by on 9/1? Oops. It is increasing by the amount that was amortized on this day. Good. And again, remember that the carrying value ultimately is going to equal $1 million. The carrying value is going to increase over the next 20 years until it equals $1 million. Okay. I know this chapter is a lot. Okay, you can tell now why I chose to have the quiz on this chapter. All right, so at this point, I'm going to let you go. So please make sure that you read this chapter and you understand it before we meet again on Thursday. Okay, just as an aside, and I mean, it doesn't affect you guys that much, but just so that you know, next Thursday is just going to be a recorded session. Okay, so we're going to have a normal class this Thursday, next Tuesday, but the following Thursday, which is September 24th, I'm just going to have a recorded session, but it really doesn't affect you. If you have any questions, you could just email me or text me. Okay, but just so that you're aware, but we're going to finish this chapter definitely live, so you can ask questions. All right, so we will continue with the slide 1050. Okay, on Thursday. Please make sure that you read this chapter. Everybody have a good day. Wash your hands. Okay, everybody stay healthy. And you're welcome, guys. Continue working hard. This is a tough chapter. The next chapter, I promise you, will be easier. Okay, it's the end, accepting an easier chapter. So have a good, you two guys. Thank you for your attention. Thank you for your participation. Okay, remember that all helps. Remember the next